All right. Well, thank you everybody for joining us this morning. Again, I want to mention that we're recording this, so if you do want to end up going back and looking at the livestock segment or the crop segment, you can go through the two links that were attached in the email, so that you can go back and take a look at some of these. Also, I'll post the presentations as well to the website. So if there are some numbers you want to look at, you can definitely end up doing that as well. What we'll do is we'll just hold all questions until the end. So after Andrew ends up finishing his portion, and then we'll answer any questions. If you do have individual questions or would like some more information, my contact information is down here at the bottom of the slide. Plus, we have some more information on Market Outlook that is available at the Crop Economics website, and then also on our budget page. So what I'm going to talk about today real quick, I'm going to give just a quick update on supply and demand for corn and soybeans, both nationally and globally. And then I'm really going to focus in on the crop insurance component of marketing and risk management. Obviously, we just went through the price determination period, so we have some actual spring prices to work with as far as looking at what we can get as far as revenue protection, or what the price is going to be if we're looking at some of our yield-based products as well. Now, what we're going to do is we're going to look at some of the considerations real quickly, and then how we can incorporate that into our marketing plan. So first off, I was up in Washington, D.C. for the USDA Outlook conference or the end of February there. They released their first kind of estimates of the 2017-2018 marketing year. So again, that's the crop that we'll be planting this spring. These are the numbers that are in purple. So one thing, this is for corn, one thing that they've estimated is that we're going to be down about 4 million acres in corn planted acreage this year. They have yield down at 170.1 or 170.7, which is down 3.9 from last year. Again, the weather's going to have the ultimate say on that, but that's essentially the trend line yield that they're using. This translates into production of about 14 billion bushels, which is actually down 1 billion bushels from last year. Now, one of the things that is also important to note on this is we still have supplies up around that 16.4 due to the carryover we had from last year, the estimated carryover of 2.3 billion bushels. Now, it's not all doom and gloom. We do have some supply issues as far as being able to work through some of the surplus that we have, but there's a couple of things that have been very strong. If you look at where we're at this year, so the 2016-2017 estimated numbers, we've had very strong ethanol production. One thing that's been I guess a good thing on the export side is that we have been able to open up some export ethanol markets, particularly Brazil and Canada have been strong importers of ethanol. And that's created a bit more stronger demand than what the USDA initially had estimated. Also, exports have bounced back nicely. You can see compared to 2015, this year we're up, roughly 300 million bushels, which is a definite positive. A big chunk of this has been partially attributed to the smaller crop than what they had down in Brazil this past year. Now they're harvesting their first crop corn, or will be shortly here, but most of their production is going to occur after soybeans are harvested. So we'll talk a little bit more about where things are down in South America when we talk about soybeans. The big thing that I want to point out is for 2017-2018, we're still estimating to have that 2 billion plus carryover. Obviously, that's going to kind of limit what we would potentially end up seeing as far as an increase in prices. We've been trading reasonably sideways in corn. We've seen a nice appreciation from the harvest lows, but at the same time, it's been very, very flat. So if you look at those global stocks, I don't think this is going to be shocking to many. We have a tremendous amount of reserves, so right around that 8.5 billion. Most of those reserves are held in two countries, China and the U.S. So again, what happens in those two countries is going to be very important. This is cumulative, so we have 4 billion bushels in China, 2.3 estimated in the U.S., and then the rest of the world at 2.2 for a total of 8.5 billion bushels. Now, you can't just look at stocks because we have to adjust that for consumption. We obviously have rising consumption over time. So one of the easier ways that I've been able to show this is the number of days of corn on hand. Simply put, that is what your average daily consumption, so take total consumption, divide it by 365 days, that's how much corn on average per day we're using for either the world, China, or the US, and then divide that, or divide ending stocks by that number. What it gives you is, it gives you a number of days if you stop producing corn, how much reserves you would have to fulfill consumption, assuming consumption remains consistent. Now, the good news is what we've seen is we've seen that run up in Chinese inventory or days on hand, but we're actually estimated to see that pull back a little bit, which is good news. As far as a global standpoint, which is these black bars, we've seen that run up from 2010 to 2014, and what we've done for 2014, 2015, and 2016 is kind of slide sideways. That's not going to cause a big price appreciation, but hopefully it will make it so that prices aren't going to be substantially lower than what they've been the last 2 years. So again, there's some positives on the use to stocks ratios. We're still not at the point where we're going to see a substantial price movement unless we have some type of weather disturbance. You look at December 2017 corn. This runs for 1 year. We had a high actually back February 28th of 404. We got on the futures contract. To me, that's an excellent starting point to end up looking at pricing some of the production, or at least securing part of the price either on the futures market or through some type of options. Also, cash contract sales would be another one that you could end up utilizing depending on what you're doing with basis. One thing that I do want to point out is we have seen an appreciation, but if you look at the scale on this side, what we've seen is basically a move from $3.70 up to $4. So it's only been about a 30-cent price move. So it's been a very gradual price increase. I'm reasonably sure that what we'll see as we move into the planting season is we'll see this market kind of drift sideways until we have a better idea as to what the acreage estimates are going to end up being. You look at soybeans, same thing. This purple number is the crop that we're estimated to plant. We're estimated to be up 4.6 million acres on soybeans domestically. Average yield, they're estimated down at 4.1. To me, yield in soybeans is the real big wild card. There's a lot of speculation out there that with some of the improved technologies that we've had for soybeans, that we've kind of adjusted our trend line yield up a little bit higher than this 48. Obviously, weather has a huge say on where final yields are, but at the same time, we have seen some very strong yields. The question is this 48 reasonable, or are we going to be a little bit higher than that if we do get an average growing season? I know there's no real measure for an average growing season, but at the same time, where this trend line yield is really going to impact what we have as far as supplies and consequently translate into ending stocks. Now, the real good news on the soybean side is that we've had fantastically strong demand, both domestically and for export markets, primarily China. You can see the numbers that we've moved from 2014 of 1.8 billion up to an estimated 2.1 billion, a substantial amount. So we're exporting almost half of our, or a little over half of our production for the 2017 season. This is a good thing. It also does have some warning signs attached to it. Obviously, most of us have heard about some of the potential as far as bilateral trade agreements between countries. This could be a very good thing for trade. It could also be put up some red flags as far as areas of concern. The big thing right now is it's just not known. The issue that I have with bilateral trade agreements, or what I would suspect, is these are going to take a while to end up being negotiated and being implemented. So I don't see this as a major market mover for this this production season. Obviously, there's going to be speculation, which will move the markets, but I don't see anything being formalized immediately, particularly since we still haven't even confirmed the Secretary of Agriculture. So I would say that this is probably something that is a little bit further down the road. Now, what's going to end up impacting exports in the short term right now? is most likely going to be exchange rates. Exchange rates are something that I think are going to be very important to track. That if the US dollar continues to get stronger, it's going to provide some headwinds for exports. So again, I would look at the trade side of things. The agreements are more of a longer term concern. The exchange rates, I think, are what's going to end up affecting what's going on short term. The other one that's going to be very important is obviously the Brazilian soybean crop. There's a lot of speculation out there that this is going to be a record crop. How big, I guess, is the ultimate question. And then, as with most of the case in South America, is the transportation and logistics remain a major issue. So how quickly they can get it to port, fill those ships, and fulfill the needs over in China and Southeast Asia. What we are estimating right now is roughly a 420 million bushel carryover, which is up substantially from 2 years ago, but roughly the same as what it was this past year. They have a U.S. season average price of $9.60 a bushel, and that's a farm gate price. You look at stocks, similar to corn, we've ended up seeing a build of stocks up to 2.9 billion bushels, primarily held in Argentina and Brazil. A lot of this is due to the timing of the marketing year. If you remember, marketing year runs from September 1st to August 31st, so obviously that's usually when the U.S. has their low point in stocks, whereas Brazil and Argentina in particular usually still have some reserves. Argentina still has a high tariff rate internally for exporting raw soybeans. So again, what ends up happening there is they encourage domestic crushing, and then they export soybean oil and soybean meal rather than the raw beans. So they do typically hold larger reserves than, say, Brazil or the U.S. You look at days on hand, this one gets a little bit more confusing. Again, the black lines are global, and we've kind of moved sideways. What we've seen is a decrease in Chinese soybean inventory on hand, which is positive for prices, but a dramatic increase in U.S. days on hand. Now, I suspect that this number will probably come down a little bit due to stronger export demand and domestic crush than what was initially reported by the USDA, but we have seen kind of, I guess, an offsetting direction from China versus the U.S., which is kind of indicated that prices are moving sideways. And if you look at where the November 2017 soybean market, this does bear it out. If you look from September 2016 until the high in November, we've seen a little over $1 appreciation in the November soybean contract. Since then, we've traded pretty much completely flat between $9.80 and $10.40. I still think that prices above $10 on the November contract is a great starting point. Given some of the risks with some of the exchange rate risk and the potential for a trade disruption, I do like the idea of pricing a little bit more on soybeans before planting than what we would do in a typical year, just because of the unknowns. There's strong demand that's at work that can be a positive for price, but there's some concerns about a trade disruption that could end up causing price to really come down. The other one is obviously that South American crop. Getting a handle on how big that one is going to be very important for soybean prices. So if we look at 2017 new crop cash prices, where we've got corn right now is $3 to $4.25, soybeans $8.50 to $10.75. Cotton, I'm not going to talk a lot about, but again, there's some positive things in price action going on with cotton. Wheat is suffering from, again, high supplies, high global supplies, and basically flatline global demand. We haven't really seen the increase in demand for wheat that we have both in corn and soybeans. So if we're looking at the 2017 marketing year, so the upcoming crop, a couple of key points. Obviously, how big is the Brazilian, Argentinian corn and soybean crops? There is consistent conflicting reports out there on how much damage some of the wet weather has caused. However, kind of the consensus is Brazil's going to have a record. Argentina might be down a little bit. So how those numbers play out are going to be very important for our exports, and then also consequently prices. If we look at domestic planted acreage, what the estimates that the USDA currently has is corn down 4 million acres, soybeans up about 4.5, cotton up as well. So again, if those if the weather holds and producers are able to plant what they want, we'll likely see some of that increase into soybeans at the expense of corn, and maybe a little bit more cotton in the mid-south. Now, if the planting weather does not hold, then all bets are off. I mean, the old adage that in Iowa, if they can plant corn, they're going to plant corn. We'll have to see what the weather does. If they get those planters rolling, sometimes it's tough for them to shut them off, even if they are looking at relative prices. Trade agreements, as I mentioned, that's probably more of a longer term influence on the market, but in the short term, exchange rates and this South American crop are going to be the big ones that are really going to drive stuff, and then obviously weather. Now, what I want to talk about real quick is kind of some marketing risk management strategies. Obviously, I'm going to have a special emphasis on crop insurance due to the time of the year that we're in. Just to kind of review real quick, one thing that I think is very important in today's environment is to make sure that we're relying on our network of support as producers. I think it's very imperative to keep these 6 people, or a combination of these 6 people, involved in some of the decision making. Some of these decisions are very complex. Crop insurance is not the easiest system to end up figuring out, so relying on your crop insurance sales representative to get timely information about the best product that's going to manage risk, I think is imperative. Now, obviously, the other 2 that I've got highlighted here, to a lesser extent, you want to make sure that your crop insurance sales representative, your lender, are on the same page. That's going to end up helping you out, give your lender hopefully some, I guess, some added security or confidence that you're managing risk, and then also your broker and your marketer, because as I step through this, I hope you can end up taking a look and seeing how a crop insurance program can also form the base of your marketing program as well from a risk standpoint. So if you look at the first step, building budgets, we need to know where we're making money and when we're not. So obviously there's a couple of things you can do when you build the budget. You can compare profitability of crops, see which ones are going to be more profitable on the farms that you are producing on, and then also determine those break-even prices for a target yield. And that essentially boils down to when you're making money or you're not, and at what yield and price scenarios you are making money. This little matrix right here, I think this is a fantastic tool from a marketing standpoint. This is for corn. Essentially what it allows you to do is this $4.91 per acre is an estimated cost of production. This is what we have in our budgets that we produce annually. You can end up going, and this tool is available online. It's just an Excel spreadsheet. You put in whatever cost of production number that you want. So if you're higher or lower than the $4.91, you can just type in that number, and it'll give you the combination of yield along the top axis or price along this this vertical axis, where you're making money for this specified cost of production. So again, the way to read this, if you're targeting 150 bushel corn at $3.75, you're making roughly $71 per acre if your cost of production is $4.91. Now, the one thing that I always say, it's great to do this at the beginning of the year, but again, what's also very important is to do this on an ongoing basis, because we know that as we're going through the production year, our yield expectations are continually changing. Sometimes Mother Nature really cooperates and we can maybe get up into this 170. Sometimes it doesn't. We're down maybe 100, 110. At least we'll know where we can make some money versus where we're losing money on individual fields or individual commodities. So the one I want to focus in on today is crop insurance. Obviously, we just went through the price determination period. I'll go through the prices and the volatility factors that were developed from there. The first consideration I always say, for the vast majority of people and circumstances, I'm a big proponent of the revenue product. There are circumstances where yield insurance does make some sense. You have to really run the numbers and make sure that you're getting adequate risk protection if you are looking at yield versus revenue. But the vast majority of circumstances that I see, the revenue product is one that's going to end up providing a little bit more protection than yield for the premium paid. The next one is production practices. You have to evaluate the production practices that are available to you. There's a completely different premium structure for organic versus irrigated, so you want to make sure that you're going through those scenarios if those are available to you. Another big one is the APH. Obviously, we calculate our APH. It provides the base for our crop insurance protection. So you want to end up looking at those yield exclusion opportunities to see if it makes sense that you can get a little bit higher protection for either an equal or lesser premium. So looking at those types of scenarios with your crop insurance representative is very important. The next one is unit structure. This one is one where there's typically some confusion. You basically have the 4 different types of units. You have optional, basic, enterprise, and whole farm. Optional is attached to specific field and commodity. Therefore, it provides the most complete coverage. It obviously has a higher premium, so those are your trade-offs. What you want to end up doing is looking at, looking at the different unit structures that are going to make sense. Enterprise basically pools more of your land together, so there's some benefits of getting a lower premium, but it also reduces the likelihood of a potential payout of crop insurance. So weighing those differences are very important. And then also buy-up level. Are you looking at buying between 50 to 65, 75, or 85% in some cases? And then obviously that has direct implications with what your premium cost is. So just to kind of look, these are what the prices that we're looking at from the projected price determination period, which was February 1st to February 28th. So for 2017, we have a corn price of $3.96, a soybean price of $10.19, and a cotton price of 74 cents. The volatility factors. Volatility factors are used in calculating how much the premium is going to be. The higher the volatility factor, the more risk there is in the price, and therefore the higher your premium will be. There's a whole an extensive methodology to calculate the implied volatility in those, but essentially if you are having a higher volatility than last year, for example, your premiums will be a little bit higher as a result of that. Now when we compare 2016 to 2017, there's 2 things that become abundantly clear. All 3 prices are higher in 2017, which is a good thing. Gives us a higher base as far as our revenue goes. But almost more importantly, if you look at the differences between those, where you have corn at $3.96 versus $3.86, that's a 10-cent difference. Soybeans $10.19 versus $8.85. That is a huge difference. And again, I think this is one of the things that's going to drive this plan at acreage. I mean, if you're in a major soybean producing county, that is a completely different risk management profile than we were in a year ago. And I put a little note on the bottom, think in terms of relative price change, right? Typically we have corn or soybean to corn price ratio of about 2.6. Well, that 10-cent change in the corn price should roughly translate into a 26-cent bushel change in soybeans. Instead, we had $1.34. Now, obviously, that's not the only things that are going into the decision, because there's also changes in yield consideration and cost structure. But it's a different set of circumstances this year as opposed to last year as far as what you can get in terms of revenue protection due to how these prices were set out. Again, cotton is up 14 cents as well, which in West Tennessee, I don't think it's at a high enough level that we're going to see people that completely exited the cotton industry start planting a whole bunch of cotton, but those that were in the cotton industry through some of these leaner years, they'll increase their acreage. I think we'd have to get closer to that 80, maybe 85 cent to attract new entrants into the cotton industry. But again, we will see an increase in cotton acreage due to these higher prices. Now, if we look at the premium subsidization, again, I mentioned the importance of unit structure. And so if you look, I've highlighted 3 buy-up coverage levels, 65%, 75%, and 85%. These are the percentage of premium paid by the federal government. So you can obviously see for whole farm unit and enterprise units, you have a lot higher premium subsidization than you do for basic and optional. What you have to keep in mind is, again, this is pooling of risk. So again, your likelihood of getting a payment out of enterprise is typically going to be less than if you have basic or optional. So you have to weigh those 2 factors, and you really want to run through some of these scenarios with your crop insurance representative, particularly if you farm in multiple counties. There can be some really interesting scenarios where you might be able to use enterprise units on certain fields if you farm across multiple counties, because you can get a similar benefit as a basic or optional depending on where some of these fields are located. So we're running these scenarios with your crop insurance representative is imperative. If you look, I did a quick example for Montgomery County, Tennessee. This is for corn. It assumes 100 acres and 140 bushel APH. So you can see at 85%, the total liability coverage is $47,124. It decreases as you reduce your buy-up. Your total premium, again, also ends up decreasing. And then the producer share. You can see this ratio to producer share to subsidy is going to be reflective of those percentages. Now, when we look at this loss trigger, this is where you would potentially get a payout from your crop insurance. This holds price constant, which we know is not necessarily going to be the case. But if you had 140 bushel APH, where you would start to end up getting a payment is if your yield ended up falling below 119. If you only buy up to 65, you would have to get down to 91. So again, there's trade-offs in where you think those payments would potentially occur and the coverage that you need. So trying to put it all together, just know how much risk you have or how much money you have exposed. So I'm using that same cost of production of $491 per acre, an APH of 140 bushels, and then a projected crop price of $396, and then these three different coverage levels. So to get your revenue guarantee, what you'd end up doing is taking your APH multiplied by your projected crop insurance price multiplied by your coverage level. So for these three scenarios, you get $360 an acre, $416, and $471. Now with those different buy-up coverage levels, you're looking at different producer premiums. So as you end up increasing the percentage of buy-up, you're going to increase your premium cost. What we want to get to is this G, the uncovered costs in dollars per acre. So we're taking our cost of production, taking our cost of production of $491, we're adding that premium in because that's another cost that's going to have to be put in there, and then we're subtracting our revenue guarantee because that's the amount of revenue per acre we have protected. So under the 65% scenario, we have still $142 of uncovered revenue, or uncovered cost, I should say, that is not protected by our revenue insurance. As we buy up, it decreases. Again, finding that sweet spot as far as where you're comfortable with uncovered cost is going to be traded off between that premium cost. So what we want to end up doing is use this as a base to end up building our marketing program off of it. This gives you an idea of how much money we have uncovered on an individual farm. Now again, I will caveat this with a couple of things. Unit structure really, really matters here. If you're in enterprise units, this changes the scenario a little bit because you're pooling a bunch more acreage together depending on how many farms you have. So what you would end up having is not necessarily the exact same scenario here. This works very well for optional units. You have to run the scenarios for enterprise and make some assumptions if you're trying to determine how much of your costs you do not have covered by a revenue product. So these numbers right here is what we can end up using to really incorporate into our marketing plan. So once we've done that, once we've looked at our crop insurance, that's when we can look at some other marketing alternatives, and obviously those include harvest sales, multiple locations, different poultry houses, that type, or poultry farms can be another place based on different locations. Cash contracts, cash forward contracting, some production this time of year I think is always a good option, but we do want to take advantage of those in-season opportunities. If we remember back to last year and the year before that, we had opportunities in that June-July time period where we had prices well over $4.25 on the futures market for corn. That's another one of those ones where we really want to take advantage of those types of situations. And so if you know where your cost of production is, know how much your crop insurance is covering, it's a little bit easier to maybe pull the trigger on some of those sales to secure a little bit more on the marketing side. Then again, futures and options, not for everybody, but I think a very valuable tool, particularly some of the option strategies that people can work on. I think options are a very underutilized marketing tool. So we want to make sure that we're working through that with our broker and or marketer. And then obviously storage. I'm also a big proponent of not putting all your eggs in one basket. Last, I mean, this is something that we always want to end up doing, is we want to continue to reevaluate key changes during the production year. Also take a look at changes in global and national supply and demand, as well as what's going on in your local region, so that you can evaluate whether your marketing plan needs to be modified. Examine your changes in price, yield, and then consequently profit. The one that I didn't mention in that profitability matrix that changes during the production year as well is the fact that you might have to add in an extra spray, or maybe you can get away with not making that extra spray. So again, you can adjust that cost of production in season with that marketing matrix as well.